A very warm welcome to each one of you. So today I would be talking about the key sectoral outlook. I would be focusing on what has happened in the past. Like for example, last 4 years we have seen phenomenal rally in the Indian markets. Many sectors have gone up. How they have done in the last 4 years from the bottom of the COVID lows till date. How have the sectors performed? Going forward, what would be the top sectors in focus, and obviously the emerging sectors from a long-term perspective. So, as Raj mentioned, I'm Nirav Vora from GM Financial Services. I head the research advisory desk. Been into the market for last 18 years, have seen the good, bad, uglies, and have learned over a period of time how to analyze stocks and markets. So it's my pleasure to run you through this particular presentation, which I'll be talking about for next 45 minutes, and then probably we'll have a quick Q&A session. So I hope this session is fruitful and useful to all of you. So now talking about the past performance, what we have done is, let me run you through this particular slide. We have taken Nifty 500 as the set of 500 stocks, and then we saw which sectors have done well over the last 4 years. So from 1st of April 2020, okay, that is exactly after the COVID had started, Nifty was somewhere around 7,500, 8,000 odd levels. So from those levels, how have the stocks performed in last 4 years till date? So we have taken Nifty 500, as I mentioned, as the entire universe. So out of these 500 stocks, obviously there are many stocks across sectors like capital goods, telecom, metals mining, IT, power, construction, realty, and so on. So you can clearly see that from the bar chart which we have shown here. So the best performing sector has been capital goods. So let's say there are 20-25 stocks from that particular space in Nifty 500. So collectively, on an average, the sector has gone up by 1400% over the last 4 years. So this is how we have combined the data. And you can clearly see that it has outperformed each and every sector. The second best performing sector has been telecom with returns of 1147% over the last 4 years. So these are the absolute numbers. Followed by metals and minings, which was up 1100 odd percent. Automobile and auto components, which have given returns of almost 950%. Power, which has given almost 855%. IT, which has gone up by 781%. And so you can see, likewise, healthcare during the time of COVID, it was up significantly, but then last couple of years had been a little challenging. So net on a 4-year time frame, it has given 251 odd percent. So this is how the sectors have performed over the past 4 years. Now, interestingly, let's deep dive into each and every sector and see which were the top 5 companies with the highest returns in each and every sector. So from auto components, we got HBL Power Systems, JBM Auto, Ramkrishna Forgings, Electra Greentech, and Tata Motors DVR. I'm sure many of y'all must be having these stocks in your portfolios. Obviously, the entry levels must be different, but overall, from the lows of 2020, that is April, till date, all these stocks have given phenomenal returns. I mean, HBL Power has gone up by almost 6,000%. Now, going to capital goods sector, CG Power and Industrial, it has given 13,730 odd percent returns in last 4 years. So, likewise, you can see for the rest of the companies, there are many stocks from the chemical stocks which have given more than 1200% returns. In construction also, RVNL, typically from the railway space, has gone up by almost 4,000% in last 4 years. So if you look at various sectors, we have taken this data across sectors. Consumer durables, BLS International Services has gone up by almost 5,300%. Financial services, BSE has given 2,650 odd percent returns. IT, KPIT Tech has given almost 5,000% returns. In healthcare, Poly Medicure has given 851% returns. So net, if you see, we have seen a phenomenal rally across sectors in last 4 years. So the point which we are trying to make here is markets have done really very well. If we talk about Nifty also, Nifty 50 stocks, which are the top 50 companies in India, on a CAGR basis, the returns have been somewhere around 15% for last 4 years. Okay, so prior to that, if you take a time frame of let's say 5 to 6 years, the CAGR return was somewhere around 12%, because we were struggling because of high inflation and many other economic challenges. But post that, when the Modi government came into action, we saw significant money flowing into the Indian markets. FIIs, DIIs, a huge amount of money has come into the Indian market, especially on the domestic front. I would say, enormous amount of money has come. The markets have got a very broad. If you look at last 4 to 5 years, a lot of IPOs have come on the mainstream as well as on the SME board. So eventually, the markets have become broader and broader. Retail participation has gone up significantly. To give you a number, 4 to 5 years back, the SIP data on a monthly basis, which used to come, which the people used to invest in the mutual funds on a monthly basis, was somewhere around 6,000-7,000 crores. Today, as we are talking, it has touched 23,000 crores on a monthly basis. So just imagine the number of money which is getting into the Indian equity markets, from 5,000-6,000 crores on a monthly basis to 23,000 crores on a monthly basis. And I'm pretty sure till Diwali of this year, we might touch 25,000 crores on a month-on-month basis. So that's a significant amount of money which is getting into the Indian equity markets. And this is just the beginning. There is a long way. Next couple of decades will be for India. In fact, if you look at the global challenges also, since last couple of years, we have seen wars happening. We have seen the inflation going off the roof. We have seen the interest rates going off the roof. Still, apart from all these challenges which the entire globe has faced, the GDP growth rate which India is delivering is significant. India is growing at almost 7%. In fact, the recent RBI policy which had happened, the governor has mentioned that India for FY25 will grow at 7.2%. So no other country in the world is expecting that kind of growth, and that's significantly that's specifically the reason why Indian markets are doing very well, and the inflows are very, very strong. Now the important question is, this was just the I've just set up the context, and this was just the background as far as the Indian markets were concerned and the sectoral performance was concerned. But now the main question is, ye to ho gaya, ab aage kya? So what is the way forward? So there are few important questions which we need to answer. That whether the past sectoral performance which has already happened in last 4 years will be the same in future. So will the future sectoral performance be the same? So I feel that obviously not. It is not necessary that all the sectors which have performed very well in last 4 years will perform in a similar fashion over the next 4 years, or they will deliver similar returns over the next 4 years. So having said that, looking at the current market construct, looking at the current domestic data points, and obviously the global scenario, we have identified few sectors from a short-term perspective, medium-term perspective, and long-term perspective. So every day, we keep getting calls from various sources, and we try to understand kaun sa stock chalega, kaun sa sector perform karega. So we, with our fundamental understanding and some bit of knowledge, we have gathered some data for you, as in which sectors will do well over the short, medium, and long-term perspective. And also I will be talking about the emerging sectors which we feel will do very well over long-term period. So now let's focus on the short-term period first. So looking at the current market scenario, we feel that over next 1 to 3 months, some of the sectors which will do very well and which will outperform the market, broader market, are consumer, that is the FMCG space. So why do we feel that? Because looking at Q1 numbers, we feel that there is a steady recovery in the volume growth. So as we speak to various management, we come to know that the volume growth is picking up, the rural consumption is picking up. Plus, we have seen some kind of margin expansion happening across various names like Dabur, HUL, and the likes. So FMCG space is looking very attractive. One more reason why we are positive on FMCG space is that the festive season has already begun. In fact, the second half of the year, we have a lot of festivals coming in. So typically the demand recovery is seen, and the volume growth picks up. So from that perspective, we have seen to an extent some stocks going up already, but the momentum can further continue. So from a short-term perspective, definitely one should keep this particular space sector in mind. Second is consumer durables. Again, last couple of years were very challenging for this particular space, especially because the raw materials had gone off the roof because of the inflation, and that had a bad hit on their margins. But having said that, most of the headwinds are behind now, and we feel that strong revenue growth will be seen in the coming quarters because the demand will be back. Again, we have spoken to various managements, and they are pretty confident of 30 to 40% growth in the coming quarters. So from that perspective, the margin recovery will be very strong. And already we have seen some of the names like Voltas, Havells, Blue Star doing very well, and the stocks are also moving significantly. So again, from a couple of months perspective down the line, one should keep consumer durables in mind. The third sector which we like is healthcare and pharma. So again, strong growth visibility is seen. Q1 numbers for many companies were very, very strong. As I mentioned earlier, that last couple of years, healthcare pharma had been a subdued space. In fact, during COVID, we had seen significant amount of rally happening in most of the healthcare and pharma names, to the extent that many stocks had gone up by 4 times, 5 times, and even 10 times during that 1.5 year kind of a time frame. But post that, we saw some kind of price correction and then time correction as well. But after that, since last couple of quarters, we are seeing that the growth is now picking up. In fact, the US sales data is also robust. So from that perspective also, the volume game is picking up. And the domestic formulation as a space, we are seeing strong growth recovery. So all in all, we see that healthcare pharma should do well from a short to medium term perspective. And also we are positive on this particular space from a longer term perspective as well. The fourth sector which we like is non-lending financials. So now when I say non-lending financials, it is typically those companies which are not the lenders. So the likes of the capital market players. So for example, BSE, that is Bombay Stock Exchange, or something like a depository. So in the listed space, we have CDSL. Apart from that, the AMCs, asset management companies, or the wealth companies which are listed, something like 361 Wealth, or something like UTI AMC or HDFC AMC. All these are a part of capital market, and we feel that this theme should do very well over the short term period also, and from a longer term perspective also, because the equity markets are getting broader and broader, and the retail participation is getting stronger and stronger. Apart from that, few other non-lending financials like insurance, general insurance players should do very well. So from that perspective, ICICI Lombard can be looked into. Again, this particular quarter, Q1 numbers were very strong. The PAT margins were almost 50% on a YOY basis. So overall, with the festive season coming up, and in case the auto sales picks up, so the motor insurance will also pick up. So that would be beneficial for a general insurance player like ICICI Lombard. So all these sectors are preferred from a shorter term perspective. Moving ahead, some of these sectors which one can look at from a time frame of 1 to 6 months are IT. So again, we have seen that IT was a lackluster sector since last 1.5 to 2 years. Obviously, before that in 2021, we had seen a phenomenal rally across IT names, be it large caps or mid caps. But post that, we saw correction of also 40 to 50% in many mid and small cap IT companies. But having said that, now that across the globe, in case the rate cuts begin, which is expected from September, that is the early sign of recovery, and already to an extent, some of the IT names have gathered momentum and they have started picking up. In fact, the deal wins which we have seen over last 2 quarters have also started gaining momentum. So the demand recovery is seen across the globe. So from that perspective, we feel that over next 6 months kind of a time frame, IT should do well. So some of the names like KPIT Tech, L&T Technology Services, Coforge for that matter from the mid-cap space, and some of the large-cap names like TCS, HCL Tech, and Infosys should do well from the large-cap space. One very interesting space is housing finance. So we have seen that this sector was also, going through some kind of headwinds, but we feel that most of the negatives are now priced in. And as I mentioned, that going ahead with the rate cuts happening, because real estate as a space is doing very well, there is a lot of demand for the houses in tier 2, tier 3 cities and also the urban cities. So housing finance as a space should do very well. Some of the names like LIC Housing Finance, Canfin Homes, and PNB Housing should do well. In fact, a couple of names have done very well in the recent past, but we feel that from a medium-term perspective, they should further continue to do well. So as I mentioned, real estate, we all know that month on month, the registration data has been very strong since last couple of years. The pre-sales volume growth is again very strong. And we feel that this momentum will continue with the rate cuts happening after almost 1.5 years. So all those people who were actually waiting for the rate cuts might go ahead and book the homes going forward. So again, from a 6-month perspective, we are very positive and bullish on this particular sector. Again, building materials, which is an associated sector to real estate, should do well because आपका घर बिकेगा तो बहुत सारे associated sectors will be beneficial. Like for example, paints, to an extent, pipes, adhesives, etc. So all these sectors will do well. So again, one can definitely keep that in mind. Now, some of the sectors from a long-term perspective which we like are telecom, power. Again, IT I have mentioned from a medium-term perspective also and from a long-term perspective also, because over a period of time, since these are all cash cows, they will do well and they will keep getting good deals. Telecom, obviously, the recent tariff hikes which have happened will translate into the revenue from the next quarter itself. So the ARPUs of most of these listed players like Reliance, Bharti, Vodafone will improve, and obviously the margins will get improved. So one can definitely look at this space from a long-term perspective. Power, which is the talk of the town, I mean, it has done very well since last 1.5 years. But overall, if you look at India, the demand has gone up significantly, multifold. So from that perspective, a lot of focus is getting shifted towards the renewable energy also. Obviously, the thermal part will keep performing well because we have seen that this year the heat waves were very severe. The summers were very severe, the power demand was very, very severe, and going forward also we feel that for next 5 to 10 years, this particular space should do very well, especially on the renewable side also. IT I have already mentioned, early signs of recovery are seen, so from a long-term perspective, one should definitely look at the mid-cap IT names, which can be the large caps of coming years. EMS, this is very important space which we are looking at. Electronic manufacturing services. So IT services, 20 years back, we used to see TCS and Infosys growing at 30-40%. Today, we are seeing some of the EMS companies like Key Technology, Sirma, Dixon Technologies growing at 20-30-40% year on year. So one of most important space one should have in the portfolio from a strong revenue growth outlook, and obviously the order inflows are also very, very strong. So one can definitely add these names in dips. Internet, overall, everything is getting digitalized. New age stocks are getting listed. A lot of IPOs have come in last couple of years, and the financials are also improving. The likes of Zomato, one classic example, which was a loss-making entity a couple of quarters back, and now it has started declaring profits. And day on day, we get to hear a lot of news around Zomato, and the financials are also improving. So that's one thing which can do very well over a long-term period. Retail as a space is doing very well in India. Demand momentum, though it has been slightly weak since last couple of quarters because of the high inflation and the higher interest rates. But eventually, we feel that from second half of this year, with rate cuts happening and demand picking up, Retail as a space should do very well. So some of the companies like DMart, Trent, which has been in focus since last couple of years and doing phenomenally well, should do well over a long-term period as well. Consumer as a space, I had mentioned that we are looking at from a short-term perspective. It is looking very attractive. So all those traders who are looking for 5 to 10% kind of gains over 1 to 3 months kind of a time frame can definitely look at consumer space. But if you have seen last 15-20 years, consumer as a space, that is the FMCG, these are all cash cow companies. They have a huge amount of cash on their balance sheet. Their ROEs, ROCEs are also very high, and they are steady compounders. I mean, if you look at Asian Paints, Pidilites, HUL, and many such names like Varun Beverages, Titan, all these companies have done very, very well. From a long-term perspective, they will keep moving like tortoise in a very steady fashion, and they will keep building wealth for you. Chemicals is one space which is looking very attractive from a long-term perspective, though last couple of years have been a little disappointing because the margins were under pressure. But having said that, since last 1 to 2 quarters, we are feeling that the revenue trends have now changed. Most of the headwinds are behind, and we will see some of the tailwinds coming into play. But still, we feel that one should buy the chemical names in 2 to 3 tranches. There can be some sideways movement, some consolidation in the stocks in these sector. But from a 5-year perspective, a 3 to 5 year perspective, one can definitely buy from it in 2 to 3 tranches. Healthcare pharma, I have already spoken about. We like it from a short-term perspective as well as from a long-term perspective. So one can definitely look at it as a long-term play. Defense again, one sector which we are very, very bullish from a longer-term perspective. But having said that, we have already seen huge amount of rally happening across most of the defense names in last 1 to 2 years. So having said that, the valuations are definitely on the higher side. So I would not suggest to buy the stocks immediately, and you should not go all out. In fact, some of the stocks like Mazgaon Dock, GRSE, Cochin Shipyard, HAL, BL, most of them have corrected anywhere in the range of 15 to 40% in last couple of weeks. So 2 to 3 weeks back, we were mentioning to all our clients to book some kind of profit across these names. Especially to those traders or investors who were looking at for short to medium term gains. But having said that, all those clients who are wanting to build positions from a 5 to 10 year kind of a time frame, one should definitely add these names in every dip in 2 to 3 tranches, because the order books are very strong. India as a country is emphasizing on Make in India and Atmanirbhar Bharat. The exports of these defense stocks, I mean the defense companies, have increased since last 3 to 4 quarters, and we feel that this is one space which will generate wealth for most of the investors. So definitely should pick up all the stocks in a gradual fashion. Yeah, so I have already spoken about these sectors which one should look on. Now, there are some sectors from a short to medium term perspective, that is maybe from next 2 to 4 months kind of a time frame, that one should be little cautious on. So the first sector is cement. Now, why we say that cement one should be cautious over short to medium term is because the volume growth has moderated. So whatever we are reading and understanding, and in fact after talking to the management, we have felt that the realizations have also gone lower because of the price correction. So typically quarter 2 of every year is slightly disappointing because of the monsoon. So the construction activities also becomes a little on the it goes on the back foot. So from that perspective, the Q2 numbers will also be a little subdued as we had seen in Q1. But having said that, from a longer term perspective, we are definitely positive on the space, because infrastructure is a story for India for next 1 decade at least. So cement will definitely do well. But from a short to medium term perspective, you have already seen that the stocks have gone sideways since last couple of weeks. So the likes of Ambuja Cement and many other mid-cap names like JK Cement, Birla Corp, Dalmia Bharat, they are hovering in a very narrow range, and they have seen some kind of consolidation and correction. So we feel that this consolidation can further continue for a couple of months. Post that, again the activities picks up, and maybe there will be price hikes, and then eventually it will do well. But short term के लिए थोड़ा संभलना चाहिए. The next sector is industrials and capital goods. Already we have seen phenomenal rally, as in the PPT also, in the presentation, the first slide which I have shown you, almost 1300% these sectors have gone up in last 4 years. So the likes of L&T, ABB, Siemens, Thermax, Cummins India, most of these stocks have gone up by 3 to 4 times in last 4 years. So if you look at the valuations after this particular rally, valuations are off the roof, and hence at this point in time we don't get that particular comfort to buy the stocks at this point in time. So some price correction, some time correction has to happen, and we have already seen that happening across names. So from that perspective, 2 to 3 months should avoid. In case there are any corrections, then only you should enter into this particular space. The same applies for railway and defense, because the valuations are high. Most of these names have gone up anywhere in the range of 2, 3, 4 to 8 times, okay, in a span which is very, very short. Last 1 to 2 years we have seen this kind of rally happening. So some kind of rally has also happened because the liquidity was very high in the Indian markets. So everything has gone up. Where the fundamentals are also not sound, those stocks have also moved up. So it is very, very important to understand that this particular rally will definitely not continue over the next couple of years, and if you get stuck up on the higher levels, the stocks might correct 30, 40, 50%. Okay, so please try to understand that you should not get carried away in this euphoria, and be a little realistic. So order execution will be very, very important for railway and defense names. Orders they have already got, but how execution is taking place over the next couple of years will be very important. So from that perspective, should be a little cautious on these two sectors. Again, auto, the growth is moderating in the passenger vehicle segment. So to just share some data points, almost 7 lakh crores worth of passenger vehicles are present right now across various names like M&M, Maruti, Tata Motors combined, in terms of their inventory, okay, which is approximately worth 70,000 crores. So we can clearly see that moderation has come. Export demand is looking a little uncertain because the global scenario is not that great. So we feel that the upcoming festive season will be very, very crucial. अगर यहाँ पे अच्छा खासा माल बिक रहा है on a month-on-month basis, especially during Navratri and Diwali, then probably if we see some kind of recovery happening in the second half of this year, then we might see some kind of momentum getting built up. Otherwise, if you see Tata Motors, Maruti, they are just hovering in a narrow range. Some kind of price and time correction is being seen into these stocks. So at this point in time, from a 1 to 2 month kind of a time frame, we are a little cautious. We'll see the numbers, the month-on-month numbers which the companies declare over the next couple of months, and then we will take a call. Metals again is a very high beta sector. If you look at the Q1 numbers also, the operating performance was muted. Volume growth was very weak. Again, this particular sector is highly correlated to global events, especially it is highly correlated to China. So recently we all know that the Chinese economy is going through a rough patch. It is weak. The demand is also very weak. So from that perspective, we are not very, very gung-ho about metals from a short to medium term perspective. But having said that, eventually we'll see the data points in case the rate cuts start happening, the numbers start coming in from Q2 or maybe Q3, then we will have a positive view on the space. But otherwise, for the time being, one should be a little cautious on this space. Yeah, so now this is very interesting part of the presentation. I'll take 10 minutes. So these are some of the new age sectors which I would be talking about. These are typically those sectors which are niche, which are smaller probably at this point in time, but they have the capacity to become huge over a period of time. So obviously IT and software, we all know that it's a already emerged sector. But from artificial intelligence point of view, cloud computing point of view, cyber security point of view, digital transformation point of view, all these existing players like Infosys, TCS, Wipro, HCL Tech, they have been doing phenomenal work over the last 15-20 years. But recently, since last couple of years, they have transformed a lot towards artificial intelligence. So now the coming years will be, very, very crucial in terms of how they are gathering their pace as far as AI is concerned. So again, one should keep this particular thing in mind. E-commerce and fintech, obviously this is one evolving space. We all know that there is rapid expansion, fast growing digital payments we have seen over the last couple of years, and the disposable income is also going up. So from that perspective, tier 2, tier 3 cities have also gathered that digital sense, and most of the people are doing online transactions. So from that perspective, some of the fintechs like Muthoot Finance, Bajaj Finance, Zomato, Paytm should do well over a long-term period. Some of the e-commerce names like DMart, Zomato again, PB Fintech, Nykaa, they should do well over a long-term period. Interesting space, which I already mentioned in the utilities power, is renewable energy. Because of the demand shortage, a lot of things are now transferring towards the renewable space. But obviously, since it's an emerging space and a lot of things are happening at the ground by the government, it will take time for this particular space to evolve. So solar energy, wind energy, all these small verticals will pick up. So companies like Tata Power, Suzlon Energy, NTPC, Adani Green, all these would be the beneficiaries over a period of time. So one can definitely keep these this particular space in mind. Healthcare and biotechnology, again, one of the interesting rapid growth evolving sector, where a lot of R&D is being taken right now by many companies as far as telemedicine, biopharmaceuticals, and AI related healthcare is concerned. So a lot of companies like Biocon, Cipla, Sun Pharma, they have invested huge amount of money for their day-to-day R&D, and they are coming out with a lot of new outcomes. So all these sectors should do very well. These companies should do very well over a long-term period. EVs as a space is looking very attractive. The trend in India from the combustion engine is now changing to the electric vehicle. So from that perspective, we have seen lot of momentum since last 2 to 3 years as far as some of the EV manufacturing companies like Tata Motors, M&M, Ashok Leyland is concerned. In fact, recently we had an IPO of Ola Electric, the two-wheeler EV bike manufacturing company, which has almost got doubled in less than a month. So the whole point which I'm trying to make is this particular space will be in momentum, and it will gather momentum as and when new models will be launched across various companies, and the demand will also improve. So one can definitely keep this particular space in mind. Moving ahead, some of the other interesting sectors are agri-tech, where the agrochemicals as a space is looking very, very attractive. Where we have agri-fintechs, we have the precision farming, which is a huge prospect going forward. Digital marketplaces are also very, very interesting space to be into. So from that perspective, overall agriculture as a space is looking good. In fact, the budget this year, the recent budget, a lot of commitments have been made for farmers especially, and the rural areas. So some of the companies like PI Industries, Tata Chemicals, which are directly related to agriculture, Godrej Agrovet, Rallis India, they should do well over a period of time. Some of the other sectors I have already spoken about: artificial intelligence. Entertainment again is one space which can do well over a period of time, because India as a nation is consuming that kind of data in terms of the entertainment. So one can look at PVR Cinemas, Z Entertainment, etc. Space technology is one very interesting sector which can do really well over a period of time. we can say that it is associated with defense space, defense sector. So some of the names like HAL, BEL, Data Patterns, MTAI Tech, Silent DLM, all these, they cater to space research, satellite launch services, space tourism, which are new things and upcoming things in India. So obviously they are at the nascent stage, but going ahead, as and when the technology gets developed, all these companies will do really well. Ethanol is one very interesting space, which is again an alternative source of energy. So it's typically the biofuel which will be used into the vehicles. So some of the companies like Praj Industries, Balrampur Chini, Shri Renuka Sugar. So typically ethanol blending is done from sugar as well. So all these sugar names, if you see over a last couple of weeks, have done very well. But again, this theme should do significantly well over a long-term period. So one can definitely look at it as well. Also, we have been hearing and talking a lot about green energy, green hydrogen. So from that perspective, the entire world is shifting towards that particular space, and India as well. The government focus has been very, very strong towards green energy and hydrogen. Obviously, development of the production facilities, diversification of projects, energy storage, hydropower, bioenergy, all these things will be in focus over the next 5 to 10 years. So from that perspective, some of the companies which typically belong to this space, like Adani Green, Tata Power, JSW Energy, obviously the big names like Reliance Energy, Indian Oil Corporation, all these will be the beneficiaries. In fact, Reliance Energy in Jamnagar has taken a huge amount of land bank just to set up an clean hydrogen, green hydrogen plant. So that will take time. Next 3 to 5 years, we will see eventually how things shape up and how things come up in a significant manner. So one can definitely look at all these emerging sectors. Obviously, I've spoken about electronic manufacturing services. So as I mentioned that 20 years back, the way IT services companies like Infosys and TCS were growing at 30-40%, I'm sure that Keynes Technology, Dixon Technology, which are now growing at 30-40%, will keep growing at more than 20-25-30% for next 4 to 5 years, and they will eventually be the multi-baggers. So हम लोग हमेशा पूछते रहते कि मेरे को एक multi-bagger stock दो. ये ऐसे कभी multi-bagger stock मिलता नहीं है. You have to understand the themes, the sectors which are in focus, and obviously the numbers which these companies are delivering. So a company like Keynes Technology, which is growing at 40% since last 3 years, obviously it is growing at that CAGR, will eventually become a multi-bagger. So all these are the emerging sectors, the new age sectors, which will grow bigger and bigger in the times to come, and obviously they will make money for you. Recycling is one very interesting space. Again, in India, recycling as a theme is very, very small if we compare with developed markets like Europe and US, where recycling is a very, very significant chunk. So some of the companies like Gravita, Ponde oxides, they will do very well over a period of time. In fact, recycling can be of different types. I mean, it can be of metals like aluminium, lead, as well as we will see recycling of paper, recycling of plastic, which is a huge business and a huge money generating mechanism for all these companies. So Gravita, 3 to 4 months back, it was a 700 rupee stock. Today it has struck 2400 rupees. But still, there is a lot of room for this company to grow in the areas which I have mentioned. So definitely one can look at all these sectors. Last but not the least, defense and railways. I have already spoken about these two sectors. Already we have seen huge amount of rally happening, but this is one leg of rally. Probably some consolidation we are seeing since last couple of weeks. But having said that, every dip in these sectors will be a good buying opportunity. From a long-term perspective, we are very, very positive on defense. We are positive on railways because day in, day out, we are hearing about a lot of things happening as far as the railway infrastructure building up is concerned. New Vande Bharat trains getting introduced. the overall infrastructure of railways, the platforms, the telecom, everything is getting upgraded. So from that perspective, a lot of companies like IRCTC, RVNL, IRCON, IRFC, the Bogan manufacturing companies like Titagar Wagons, Jupiter Wagons, all will be the beneficiaries. But we need to understand that since last couple of years, all these stocks have gone up, multifold. That is in the range of 2 to 8, 10 times. So we have to be a little realistic. Already one leg of rally has happened. Some kind of time correction has to happen. Price correction has to happen. Valuations are on the higher side. So be very, very selective at this point in time. Any dips in the market, gradually in 2 to 3 tranches, keep accumulating these stocks. In fact, in these new age sectors, which I've spoken about, all these 3 slides, one can do a good SIP. You can have a basket of 5 to 10 stocks, and you can keep doing SIP for next couple of years, and eventually over a time frame of next 3 to 5 years, all these or maybe many of these will become good multi-baggers. So that's all from my side. So thank you very much, but we still have 10 minutes. In case you have any questions, I'll be very happy to answer them.
Can you suggest some study material explaining when to take entry and exit in any stock, covering price volume action, basic fundamental parameters, and candlestick patterns?
Oh wow, that's a very interesting question. So see, basically for picking up any particular stock, you need to have 2 kinds of studies. First is fundamental study and the other is technical study. Okay, technical study will be followed by the fundamental study. First of all, you need to understand that the stock, that is the company, is fundamentally sound. If the company is not sound, if it is not having all those parameters which fit into our investment horizon, then it doesn't make any sense to go through the through the technical reading. Because अगर company अच्छा नहीं है तो मैं उसका chart देख के क्या करूँगा? So first and foremost, there are a couple of parameters which are very important. First of all, the company should have a good past track record. Second is the management pedigree should be very, very sound. If the management is not very sound, and if they have done some kind of manipulation in past, then probably it is better to avoid such companies. The third is the growth momentum. The future growth momentum should be absolutely clear in terms of what exactly the management is focusing from a 1-year perspective or maybe from a 2-year perspective, whether they have a good growth path. So that is also very, very important. And finally, obviously, the quarterly numbers which keep coming in, you have to track those very closely. And last but not the least, the valuations have to be reasonable. I mean, every company can be a good company or a bad company, but if the price is high but the value is low, then probably you can still buy the company. But if value has gone up, then probably you cannot get into that company at high valuations. So the whole point is, which I'm trying to make here, is the fundamentals have to be very sharp and strong.
Thank you, Nirav. On to the next question.
Yeah.
How to identify sector rotation in the market?
Oh, again, that's a very, very interesting question. So see, a sectoral rotation will keep happening in the market at any given point in time. So to give you a classic example, if you look at the banking space, okay, last 6 months probably, or maybe last 1 year, the private banks have gone nowhere. I mean, something like HDFC Bank, it's just hovering in that range of 1600 and 1700. Kotak Mahindra Bank is hovering between 1650 and 1800 range. So, automatically what happens is, if one particular sector is underperforming, the focus will shift towards a sector which is in momentum. Like for example, banking has been a laggard since last 6 to 8 months, especially the private banking. Though PSU banks have outperformed private banks in last 1 year because the valuations were very attractive 1 year back. Okay. Now today, after PSU banks have moved up almost 2 to 3 times in the last 1.5 years, now private banks have become very, very attractive. But at this point in time, we need to understand the fundamentals also. Now, why are banks underperforming? Because huge amount of money is getting into the equity market, right? as I mentioned, the capital market space is looking very attractive as an investment. Why? Because day in, day out, people are investing into equities, maybe through direct equity route or maybe through a mutual fund route. As I mentioned, SIP numbers have gone off the roof. 23,000 crores every month is getting into equity. That clearly shows that people are not keeping their money in banks. Okay, जो normal अपना बैंक का अपने को interest मिलता है 3 to 4%, people are not happy with that. Last 4 years, people have seen that in equities, every month you are making 15-20%. So why will people keep their money in FDs also, for that matter? FDs are giving you 7-8% maximum, and in equity you are making 20, 25, 30, 40%. Okay, so this overall trend has changed. The deposits of banks have gone down. Eventually, they are not lending as per what they are expecting. So their NIMs have gone down, net interest margins have gone down. So there is a huge mismatch in their balance sheet. So from that perspective, we feel that couple of months will be still, banks will be struggling. So from that perspective, we have seen that people have pulled out money from banks. The domestic institutions have pulled out money from banks. FIIs have pulled out money from banking sector, and they have invested into the sectors like consumer space. Like for example, in budget also, there was a lot of emphasis given to rural spending. Okay. So from that perspective, we have seen in last 2 to 3 months, the stocks like Britannia, HUL, Dabur, they have gone up by 15 to 20%. So clearly, money gets rotated from one sector to another sector. So obviously, it is not. You have to read a lot about all these things. You have to be very, very alert what is happening in the market. You have to keep a track of all the news as far as domestic data is concerned, or maybe the global events are concerned. If you are on your toes and if you are able to gauge that, you can definitely keep rotating your stocks in the portfolio. So that's how the sectoral rotation happens. Now, see, if the investors are not able to do that on their own, we at JM Financial are always ready to help such investors. So it will be our pleasure that if you open your accounts with us and invest through us.
Thank you, Nirav. So we'll take up a last question due to time constraints.
Yeah.
What is the next 1 year market outlook?
Again, that's a very interesting question. So yes, as I mentioned, that last 4 years have been phenomenal for the Indian markets. Indian equities have grown at 15% CAGR. To be very precise, last year, the Nifty 50 earnings were somewhere around 16 to 18%. Okay, collectively for the Nifty 50 stocks. Now, the next year, we are expecting the Nifty 50 earning to be somewhere around 12%. So clearly, it shows that from 16-18%, the earnings will get down to 12%. Okay. So from that perspective, the investors should not have very exorbitant target prices in mind, because as I mentioned in the presentation also, that some kind of rally has already happened. The valuations have got stretched. Okay. From 18-19 times on a trailing basis, the Nifty PE has touched 23.5 times. So if you look at last 15 years, the average for Nifty has been somewhere around 21 to 22 times. So we are slightly above that particular average. So every time we have gone to these levels, we have seen some kind of correction happening in the market. Having said that, in 2021, on a trailing basis, the Nifty PE had gone up to 28-29 times also. Okay, so that was extremely on the overbought zone. So from there, we saw a good correction of 15-20% in the market. Again, the price to earning cooled off because we saw huge correction happening across mid and small caps. And then eventually the corporate earnings started delivering, and the catch-up was also seen across mid, small and large cap stocks. So now from here, from a 1 year perspective, we feel that, as I mentioned, we are expecting 12% earnings growth for the next year. Okay, that is FY25. So from that perspective, already we are at a 23.50 times on a trailing basis. So one should have limited expectations over next 1 year because valuations are on the higher side. But having said that, we had a good monsoon this year. Okay, and across the globe, interest rates are at the peak. Come September, hopefully the Federal Bank will reduce the interest rates by 25 bips, and we will see most of the central banks across the globe start reducing the interest rates. Even in India, possibly we might see 25 bips rate cut. So from that perspective, and also the second half of the year, we see a lot of festivals. So demand revival typically takes place in the second half of the year. Monsoon is good, so rural consumption can increase. So having said that, if the corporate earnings are, catching up, then probably the 12% earning growth can be at 15% also. So if that is the case, then in the best case scenario, we can see 10 to 15% upside on Nifty from a 1 year perspective. So that is typically 28,000 levels on the upside. But in case there are any global events which are, not very encouraging, if the war escalates in Middle East or something happens in US because their debt is at its all-time high, some institution goes for a toss, it goes bankrupt, and if we have ripple effects coming in, then you never know 6 months down the line what would be the scenario. So on the downside, again, you need to understand that we might correct by 10 to 15%. So the broader range should be somewhere around 21,000 on the downside and 28,000 on the upside. So that's where we are looking at the broader index view. And accordingly, the investors and traders should set their trades.
Thank you, Nirav.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.